Hello, and welcome to the Treasury Takeaways Podcast. My name is Matthew Oberkfall, and I'm the head of middle market at Wells Fargo for global payments and liquidity. For this episode, I'm happy to be joined by Derek Luxon and Nelson DeCastro. Derek is head of international sales within global payments and liquidity. Derek leads the development and growth of treasury management for Wells Fargo in Canada and EMEA. Also joining us is Nelson DeCastro. Nelson is the National Manager for International Trade Finance Solutions at Wells Fargo. Nelson leads a client-centric team located in North America, focusing on assisting our strategic commercial banking clients based in the USA and Canada. So let's get started. Derek, let's start with you. We've been hearing a lot about changes in forecasts and a bit of unpredictability in the markets right now. Can you help address those dynamics and how companies and treasurers can adapt to the environment?
What we like to share with businesses is that the only constant we know is going to be change, right? And so how do our businesses think about adapting to that change? It might be a change in one direction today and another one in tomorrow. And so part of our advice and part of what we talk to our customers about, the best way to do that is to build agility and to build a plan around approach and to account for what those impacts might be specifically to your business. And so today, looking forward to being able to dive into some of the areas in which we believe customers and businesses should be thinking about in this changing environment and changing trade environment. The first thing that we recommend is to do a stock on how might the changes impact your cash conversion cycle within your business, right? So what we're seeing across different businesses, that could mean a higher input cost, a reduced revenue, higher administration costs, or the impact of longer custom processing times due to backlogs, or a longer travel time to impact inventories or realization on revenue. So these are things that will impact each of your businesses differently, but building an understanding of these are the levers that are potentially at play, and then the impact on how that impacts your cash conversion cycle is really important. When we take that a little bit further, what businesses are thinking about, and they're trying to find efficiencies in their business. We were recently speaking with a customer who's the main focus coming down from the CEO and for the board is how do we find efficiencies in our business regardless of the changes that are happening in the overall trade environment. And this is a real focus from a treasury perspective is how are you extending your days payable outstanding or reducing your sales outstanding to drive that more efficient cash conversion cycle. And so from a payments and liquidity perspective, what we're hearing and what our customers are trying to look at is, for example, things like taking a stock of all your current suppliers. How are you paying those suppliers? Are you using channels that maximize your ability to extend the payable terms that you have in place with those customers? Historically, that might look like using a credit card for part of your purchasing program. And you might have historically had recipients that were being unwilling to accept those payment channels. But in this new environment, with the ability to potentially pay slightly sooner, with the ability to, in your currently renegotiating contract, that could be very much now a possibility that your treasury team could look at your payables outstanding within the organization. And not too dissimilar from a receivable standpoint, being able to add automation and apply payments faster could be something which also improves and releases cash faster back into the business. As we move on from there, we see businesses thinking about how do you get better visibility? We see from recent studies from the International Chamber of Commerce that the number one concern for businesses around tariffs was increased cost. And the impact of those costs are best seen having visibility and having the right forecasting in place. So here, customers are thinking about, do we have the right tools to have near real-time reporting on our transactions and our cash flows? And is that efficiently feeding into the systems that our teams are building to get that view on the impact on their business? And so what does that mean from a treasury perspective? I think here what we see business thinking about is as we look at repricing goods and services, are there opportunities to have different terms that we had historically, had different pricing as we go to new businesses? And then as well, do we have the right tools to support that type of engagement? Are we able to affect or make payments and receive payments into those new areas that we're going to? And do we have the right plan in place if it so needs, and may not be immediately needed, but for us to respond quickly to those types of decisions as a business within a treasury function? The next thing that I'd like to quickly touch on is the idea of liquidity and account structures. I use an example here. Recently, we were talking with a customer that had historically realized most of its revenue in the US, but had its supply base was Mexico and Canada. In this case, in the current environment, this company was doing a couple things. First, we talked about managing price. They went to their customers and said, we are going to pass on the impacts of the price. But they also here realized that they would likely start trying to source more materials domestically in the US. As part of that, they need to evaluate, do we have the right liquidity pools in place that had historically, the levels of cash they kept in specific regions would need to adapt to the business strategies that they were deploying within their organization. And as well, when we think about this, you might now also then start considering about, are we holding new or different levels of currencies as a business in order to meet these needs? Also now could potentially be accounting for larger shocks in need of liquidity to pre-buy inventory, or because you're having to extend as you wait for receipt of payments within your business. And when we think about those impacts, and it might be holding additional currencies, or it might be holding currencies for a longer period of time, that's where we start to see customers thinking about the changing FX components of their payment mix and their liquidity and managing that rate environment. And here, we're encouraging that to be a conversation with the experts in that space to understand how that could impact your business. And finally, one of the areas that may not be top of mind, but is really critical for our customers, is to consider the risk and fraud impacts these types of decisions or these types of changes might introduce. So when we think about this and some of the things I've talked about where you might be affecting new payments to new suppliers, or you might be entering new regions, what that introduces to your business are risks around ensuring you have the right payment information for these new vendors. You have the right controls within your business to ensure that the right payments are going out, and you have the right visibility to track that into new markets that might present new risks or new concerns. And so overall, when we think of this, and I appreciate being able to share that there are a lot of areas that we believe the Treasury function has an ability to plan for, create action against, and create agility within your functions to help address the changing environment that we see here today. And so as part of that, I'd like now to pass on to Nelson to give his perspective from a trade perspective.
Thank you, Derek. There is, important strategic thinking going on at both the ownership and C-level management of our clients, especially privately owned companies in U.S., about the new trade tariffs, about the supply chain, and how it all, is impacting their procurement decisions and strategy in both 2025 and 2026. More specifically, higher probability than ever of supply changes from China to other APEC countries, as well as how to make it happen in a consistent basis when you make these changes, and at the same time mitigate the domestic and the international trade risk it comes with such changes in a procurement. Now, we see the dramatic change in procurement from China to other countries around the world, but more specifically, where we see significant increase or deviation from since the first Trump administration in 2018, there was increased procurement for both the European Union as well as Mexico and Canada in particular. Equally important and top of mind of many of the business owners and management that both myself and my team are very actively interacting with every day, every week this year is how to improve the working capital while at the same time building new relationships with key suppliers in alternative Southeast nations, especially countries like Vietnam, Malaysia, Thailand, Cambodia, Brunei, and Philippines. We're seeing a lot of movement of procurement now moving from China to these countries as opposed to Mexico in particular and some other countries. Similar story going on with hundreds of companies. We have the honor to service with active suppliers and our clients in Mexico. that are considering to take action and expand supply chain moves to other Latin countries such as Brazil, Colombia, Chile, Argentina, and Uruguay, just to name a few. So again, a lot of procurement are going on, not just from China, Canada, and Mexico, but many other countries that sometimes we are not mentioning in these conversations and these discussions, but a lot of changes going on. In other words, they have international accounts payable on their balance sheet, and Wells Fargo is fully committed to engage and assist them to strategize how to consistently make these supply chain moves from China or other countries to countries where perhaps there are trade agreements, especially in the short term, that are more beneficial, while at the same time mitigating the trade risk that occurs when you change your supply chain, where you change your procurement, and hopefully improving the DPO, also known as the days payables outstanding. Try to extend your DPO as much as possible as you change the supply chain. Again, conversations with new suppliers are taking place, at least with the thousands of clients we're interacting with at Wells Fargo. And top of mind with our clients management is how to properly, again, mitigate the trade risk, no matter if it's political, economic, or trade payment related. Equally interesting, many of our clients with annual sales, especially between 100 million and 700 million, are now looking at current trade policies, not necessarily as just a risk, but as an opportunity to grow their business further in 2025 and 2026. Key points we are seeing and talking with our clients, specifically the strategic minds of their leaders, is could reciprocal tariffs potentially open up markets to sell or export US-based products and services like capital equipment or technology equipment that in the past faced 50% to 100% tariffs to sell their goods into countries like, for example, Brazil, or even Germany, which is obviously, we all talk about the European Union, but the reality is Germany is the key trade partner with the US, where we have a significant deficit, or even India. So again, top priority is to assist our clients navigate the storm and fully engage with trade finance tools as much as possible, plus obviously know-how to best assist growth at a time of a lot of volatility and risk by hopefully not just changing the procurement and changing the supply chain on the procurement, but potentially to grow the business by selling more and exporting efficiently to other markets that perhaps you have not considered in the past. As reciprocal tariffs are put in place or negotiations take place, or perhaps new trade agreements are agreed upon, like, for example, the recent trade agreement with UK and potentially a few more agreements coming up with countries like India, our commercial banking clients are seriously considering changing payment terms to best mitigate trade risk and improve working capital. What do I mean by these? Most US businesses are still selling or buying in US dollar, where some folks would argue that if you want to grow your sales, you may have to consider being a little bit more client-centric and selling in a local currency. And by the way, US is in best position to mitigate that foreign exchange risk as opposed to giving it to your supplier or your potential client internationally that may be with a smaller bank or with an economy that is not as sophisticated and market leader as the US. No one really feels comfortable or can predict what is going to happen next week, tomorrow, next month. So it's best to join forces, brainstorm the strategy. What are you trying to do? How you could potentially use these as not necessarily a deficit to your business and your company, but potentially as a way to grow the business. So again, thank you for listening to us, and we really look forward to further engaging with you. With that said, Matthew, may I give the word back to you?
Thanks, Derek. Thanks, Nelson. That was incredibly insightful. Sincerely appreciate the time and the insights that you both shared today. Global Treasury Management products and services are provided by Wells Fargo Bank, N.A. Wells Fargo Bank, N.A. is a bank affiliate of Wells Fargo, and company Wells Fargo Bank, N.A. is not liable or responsible for obligations of its affiliates. Deposits held in non-U.S. branches, subsidiaries, or affiliates are not FDIC or CDIC insured. Deposit products offered by Wells Fargo Bank and a member FDIC.